Live streaming is on.
All right, good afternoon, everybody. Event Trader here, and I am being joined by, of course, Brett Manning, chart trader, for the latest edition of the Sentiment and Flow Show. We're week delayed. Brett was traveling in Europe there and had some technical difficulties, but I don't
Did
think that our message is going to change all that much. So I think, so far, I know, Brett, you've been right on top of all this move the last couple of shows. Anybody that has a chance, go back and listen to the last three Sentiment and Flow shows. And I really feel like that our track record on this, Brett's been hitting pretty solidly in terms of what we've been talking about with positioning, where the money was flowing. And, while a lot of people were trying to lean on this market, you kind of just kept pointing towards those numbers, and that ended up coming to fruition. So certainly kudos to you on
well, and you,
those
sir. I think
outlooks.
we've shared a message here over the last, really, I would say, all the way back to January, that there's going to be a really difficult time going down. This market's not going to be able to make progress on its downside moves because everybody's already in that bed. And we had a real consistent and clear and comprehensive across the board picture of too much bearishness, too much bearish opinion, too much bearish positioning, too much bearish exposure in derivatives, the whole thing, and really clearly, consistently consensus. And it made it easy to be bullish against the grain. And I think we handled it well, but I also think that it's interesting that I really haven't seen any other. I haven't really come across any other kind of analytic input anywhere that's been consistently bullish for the same period.
Yeah, I mean,
which I guess is kind of the point about going against the consensus.
Yeah, it's not. It seems like it's more fun to be a bear sometimes and just point out what's wrong with everything and put out those 3,000 levels, and just note that all this could go wrong. Yet it still has to go wrong, and obviously things have not. Certainly, the corporate earnings have been a lot better than expected. That's been one of the positives there. That banking resolution. I know banks are under pressure. We'll talk about them in a little bit, but they're under pressure because of the capital requirements that regulators are looking to put in, not because there's any major fear about these institutions going down at all or anything. So all that hopefully to kind of quell any concerns and sentiment around the group. But as Brett had been saying, this is something that they could kind of print away, and as long as they could get back on their footing, things should be all right.
Stupid banking crisis.
Exactly.
Stupid banking crisis.
So we're able to work through that. Corporate earnings, like I said, econ data, mixed, you could certainly say, but not pointing towards any sort of hard landing, at least through the first half of 2023. And that what it really starts to, the biggest question that Brett and I are going to look to kind of tackle is, we certainly saw a change in sentiment. We'll get into the AAII in a second. Some change in positioning as well. And the natural question is, okay, is this rally kind of hit its stalling point, and are we ready to roll back over? And that's what we hope to tackle in today's show. So, Brett, without further ado, let's take a look at some of the things that are facing us here with market characteristics. One of the things that we've been seeing over the last couple of sessions here has definitely been a bit of a sell-off. And I'm going to ask you about that, but I want to go through a list of some of the other things that we've been seeing. Signs of breadth starting to expand as the RSP had been outperforming the SPY. I know today it's certainly the mega cap tech names. So that's going to be one of the things that we're going to look to address. Negative sentiment and short underweight positioning dynamics have started to reverse. Again, we'll kind of talk about that. One of the things that I think continues to work in the bullish thesis, Brett, was a Goldman note. And I actually saw it in a couple of different notes after even reading Goldman, where panic from retail and portfolio managers that are underexposed to this new bull market.
Let me just stop you for just 1 second. Just read that bullet point and then think about the perspective of taking a sentiment data view on the market over the last few months, and then getting that, because that's exactly it, right?
That's it.
I mean, that's
that
it.
Sums it up.
But that just, like, that's why this is such an important perspective on the market. That's why you can't have a comprehensive analytic approach without incorporating a really heavy emphasis on sentiment and positioning data. You can't, because that's what moves the market right there. Fundamentals are important, but who knows which what level you can get to in terms of price of sales or price of earnings before it's, you'd be justified in shorting the market in 1996 and you're dead by 1998. You know what I mean? So in different environments, these things are elastic, but there's something that's not elastic. If everybody's all on one side of the market, it can't go that way, period. And the move the other way is fueled by that.
Yeah, and we certainly have seen that play out here. And as you always talk about, Brett, portfolio managers, the quickest way to get removed is missing a bull market, right? So
can't possibly do that and keep your job.
You could be forgiven for missing a black swan event to the downside, because generally everybody's portfolio is getting hit and people understand that. But
right. You're just
but
part of the
sitting
crowd
on the sidelines while Johnny Lunchbox across the street's buying a new car with his returns, that's not going to sit well with people, right?
Do that. That's it. Pack it up.
Yeah. Global money market funds, 837 billion of inflows year to date. That's second best on record since 2020, which of course was COVID. But that's also money that could start reversing and working its way into equities too. So it's kind of when you're thinking of that positioning here, there's been a lot of money that's squirreled away in that safe fixed income investment. Now, whether or not they want to chase it or just kind of collect those 4% returns remains to be in focus. But
let's reframe this. The way that we frame things over, let's say the last 6 or 8 months or so, we should call that a mania in risk aversion.
Yeah.
Right? It was a mania in risk aversion, and that mania needs to unwind. Regardless of anything else, that's got to happen. And it's going to come from everywhere. And this is another one of those points that it comes. That's another one of the hot momentum plays of the mania and risk aversion in essence. Well, who can be the most risk averse? How can you be the most risk averse? Money market funds. I don't know how you can.
It's especially when you're looking at an environment where 3-4 years ago this was untouchable, right? Now all of a sudden it was providing those attractive returns that made it that much. And again, there you go with the mania, with people piling in to do that. But you got to wonder, are they willing to stick around in those 4% returns, or are they looking to get a little bit higher return on their money? So
I think part of it's going to be a social phenomenon.
Yeah,
as it happens. I mean, that's the unwinding process is, it's a social phenomenon. It's the turtles coming out of their shells.
Exactly, and that's still potentially at play, which is what we kind of wanted to try to highlight in this bullet point. And then the other on the turtle side, Brett, or I don't know if you refer to these as turtles or some sort of underground hedgehog or something, but short interest. Over 1 trillion according to the latest S3 Capital data. Now, I was trying to find that report to see exactly when that data is referencing. My assumption is
because it's going to be delayed, right?
It would have been as of at best mid-June, right? But
I don't know. I feel like it could be if you go. Let's use this as our segue to the next slide.
Yeah.
Because I'm thinking it's May 31st.
And it very well could be. And of course, that leads us to the question on how much of this rally's been short covering. Are the shorts kind of cleared out and all that? So, the point of this particular bullet point is simply that there is still a negative connotation out there in the markets in terms of
but maybe not, again, if it's May 31st. I mean, That's the question. It's like this is a transition state. Right. So we've had one thing for a while, and if you're looking at the AAII data slide, you can see this sea change. It does a good job of capturing it, and it's evident across a lot of different things that we look at. But when you get to the move from May basically to June, like you see this shift, and it's a shift from. I mean, we talked about this last time. It got up to 80 out of 83 weeks with a really abnormal spread relative to long-term historical data. In terms of bulls, somewhere around 25%, and bears somewhere around 40+%, way off of long-term averages and flipped from their normal relationship. That persisting for a year and a half, pretty much every single week, and then we hit June, and there's no event that drove this. I mean, you can look at a couple of things like optimism around the debt ceiling. I mean, this was a threshold process, and eventually, when you keep the pressure on, when the market simply keeps the pressure on, there's no downside. Things can't go lower. The market is an auction. It's not a rubber duck in a bathtub. When you get prices that can't validate the way that people are positioned, it starts to show up. And this is a threshold that we cross when you go from that May 31st data point to June 7th, June 14th, June 21st. There's a sea change there, and I would guess that short interest and the market took off at the same time. So you can see it, if you look at an S&P chart or a NASDAQ chart or whatever.
And no coincidence that came following the debt ceiling resolution, right? Where a lot of people could have had short interest just for protection down there.
Yeah, I think that's one of those sort of that's a tip of the spear, like that's an extra point, but not the main body of it. Like the main body of it is just this persistent bearishness we've seen. The end of the world in some form is about to happen. I just don't know how. There's got to be some cause of it, but people are kind of stuck in that feeling, and across the market and across retail and across professional managed money, and we've seen it in the data for a while. And then eventually, when the market can't go down, that's going to break. It's the market that broke it, right? I mean, it's the fact that we went through that trading range for 3 months in the S&P and then broke out to the upside, and then tried to reverse back into the range, failed, and popped back up to new highs. And that's about when all the sea change happened. Like at a certain point, you have to see validation of your expectations, or it's hard to maintain them. And ultimately, the rubber meets the road, on the chart. And if you just don't see that validation and for such a long period, and if you're saying, that level at the top of that range that we were at all spring, if that's not the ultimate point where, you're getting your resistance and your big rollover, if you hold up, and then break out on bad news, how are you going to stay in that psychological position? How are you going to keep the faith in that first view of the world? And, eventually the tide breaks. The wave hits the rocks, and that energy dissolves. And that's really the transition that we've seen. So we made that transition, and I would guess that last bullet point on the previous slide is probably that S3 data probably is predating that threshold shift.
Yeah. Well, be keeping an eye out on it, see if we can get any updates. But taking a look at the AAII data, you can kind of see what Brett's talking about. Where we talked a couple of weeks ago, we just popped from 29.1 to 44.5%. I think we have to go back 2 years since we had seen that much of an aggressive move from both in the bull sentiment. Just a big pop, also coming, of course, after the debt ceiling resolution there. So big drop off, of course, with the bears dropping down 12%. It rose even further going into the middle of June as the animal spirits started getting underway. A lot of the AI names were flying at that juncture, of course. We had the largest bull bear spread that we'd seen in about 3 years on that June 14th data. It has pulled back a little bit on this morning's number down. You can see the 42.9%. Neutral camp also slipped a little bit, and the bears had a bit of a uptick there, about a 5% move total from bull and neutral to the bear camp. Just kind of looking at some of the other data points here, you could see that's been running above the historical average for bulls, which runs at about 37.5%. Bears a little bit below the historical average. It's definitely been playing out in the price action. The 45.2% that we hit last week was a 1-year bullish high. So, definitely get a feeling on the sentiment there. And then just kind of looking at some of the historical averages, the 8-week moving average, the highest since January 26th. And then the bull bear spread has averaged about 19 over the past 3 weeks. And last time we were able to see something like that would have been October of 2021, which of course would have been heading into those all-time highs before we started getting that sell-off after Thanksgiving, when Powell started talking a little bit more hawkish, of course, and we also had
Got
the
the
second,
transition.
and we also had the second uptick in in the Omicron data that kind of rattled markets that day after Thanksgiving. But Brett, looking at that, this kind of all plays into that positioning that you were talking about, where you certainly saw kind of the light switch going into June and running forward. So I guess the question I'd have for you is, what do you think of the last 3 weeks of data? And then what would you be looking for moving out that would signal to you, some sort of advantage for either the bulls or bears?
The most important thing I think is going to be, and I don't know the answer, but is going to be when we see some kind of pullback that's got a little bit of legs to it. Do people immediately turn really bearish again, or do people? Is it a crowd move to, basically say, this is the opportunity to buy the dip? I'm really interested in that outcome.
Do you think we're going through that now? Because I know, just kind of watching it from my perspective, I've been watching the best pullback long list on the TA page scans. Saw feedback from one of our longtime subs who was saying that he's seen a lot of charts kind of hitting a pattern similar to that he loves to go long on. Definitely have some support coming in for some of the key areas on the 20-day moving average. The SPY and the Qs were both coming in to test their 20 days. So how do you see this test coming up? Do you think that could be the final test, or are you kind of thinking that maybe a little bit more of a pullback just to really kind of put people's feet to the fire on whether they want to buy or not comes into play?
So to get to a definite sentiment signal, there's a good chance that we just get middling as a result, and really sentiment data doesn't provide an edge, which is a lot of the time. So we watch it and we incorporate it because sometimes it provides the only important edge. It doesn't,
and that's
always,
when it's at the extremes, right?
Yeah, and otherwise it's not going to be something where you get your edge. So but you have to have it involved in the process. So the question here is, the ideal setup would be, we get it. Today rolls over a little bit into the close. Tomorrow, we get a little more downside. We start to see the put call ratio skyrocket. We start to get the sense that, it's another one of those moments where people flip to bullish, but then the second they see just a taste of downside, it's back to doomsday across the board. That buying that kind of signal would be your edge. Otherwise, even if people are bullish into the pullback, probably still going to see new highs. Bull markets do that all the time. It needs to persist in a state of excessive risk acceptance, and it would take a lot to get us there, given where we've come from.
Let me ask you this. At the beginning of yesterday's session, there was a pop in the put call ratio up to about 1.25%, been the highest that we'd seen from the put call ratio in some time.
Right at the open, though. So
well, right at the open, which I know certainly
it's going to be one trade.
Right.
It's not
But and it did come in. But I was also of the opinion too that it's coming in front of Powell, and there's also the idea that. And this is one thing that I think you could see some elevated put call ratios that might be a little misconstrued in terms of being outright bearish, but downside protection is so cheap right now, Brett. The VIX is down at 52-week lows. Probably
still above a long-term average.
What is the long-term
Well,
average?
it depends on how long of a term.
Yeah.
Yeah.
Well,
But
I know we're running between 12 to 14 for a lot of those years.
Yeah.
The short vol guys were just having a field day with that, and it's certainly seems like they have. But we definitely didn't see any pickup in the VIX over the last couple of days. That's for sure.
That's a very good point.
But the put call, like I was under the impression the put call ratio is probably just a couple of people seeing how cheap downside protection was, and they didn't want to sell out, so they just bought a couple of maybe a couple of calls.
And during the first 15 minutes, you're going to get some, like the readings is a throwaway, because it could be just a couple of people causing it, because it's a ratio. And when you only have a few orders for the day so far, in the first 30 seconds, there's only a few orders that have been processed. And the ratio of those orders is not a large enough sample to mean anything. So you really start looking at that thing at least 30 minutes into the day.
Yeah. So, okay. Well, we'll continue to monitor that going forward. But I've found that interesting, and I'm well aware of the beginning of the day elements that factor in there. But from my perspective, that was the first time that I'd seen anybody really kind of looking to move. And you can see back on the 20th, we also had a little bit of a pop there up to 117 at one point.
Right.
You're seeing more and more, and I'll show it on a put call ratio chart, a little bit of a move towards some downside protection here. And, that could also be, instead of banking profits and moving to the sidelines, just looking to kind of hedge yourself and take advantage of that. Yeah, it's healthy for sure. But it's the first time that we've seen that. So certainly that unabashed rally that we'd been getting at the beginning of June has seen a little bit of a more tepid response, and not surprising after as big of a move as we did. As
we're in a more normal.
Right?
Yeah, I imagine we're going to see all the sentiment data move back to the middle for a bit.
Yeah,
just like it's weird where it was. It's an unsustainable place where it was. It gave us a roadmap from where it was, and it's a bull market.
Yeah. So, all right. See anything else on the AAII data before we move ahead here, Brett?
I mean, I just think it's going to return to historical averages pretty much. I don't think it's going to get to you get the overshoot the other way when you get this revelation of everybody kind of hitting a threshold experience.
So do you just see that as we're entering a period of consolidation?
I don't know it very well could be a period of continued upside trending in an orderly way. I mean, you can look at there's lots of rallies that look like that. Everything is in the middle in sentiment data, and the market's just gradually moving higher. It depends on, what paradigm people are willing to accept from here. But we're not in a situation like the malpositioning. Let's just say we've had a thesis for half a year that there was malpositioning. There was a huge imbalance in the market that was unsustainable. And that, I think at this point, we can say we've gone through the process of that correcting itself.
Do you think that's completely corrected itself?
I would say my guess is you get 3 weeks of data like this and you get a move that we've seen in the market like this. I think there may be still a little bit more unwinding of the bear mania to take place, but I think that the primary part of the adjustments happen. But you got to think where that leaves us. What's the average random day in the market historically? It's an up day. There is growth. The GDP is not negative. Like when you get into a situation where it's not extraordinary circumstances or extraordinary sentiment, the average experience is some kind of grinding rally. So, it takes something special to turn that thing the other way. And even though, and people listening to this right now who are new to the site, I'm the main one who shorts stuff usually, right? Would you say?
Yeah.
Yeah. I mean, I'm the most sort of the person who is usually the most front and center person during a bear market. So it's weird to hear me talk like this, maybe, but it is what it is. It's just like we got to a weird place over the last year. It was inspired by things that are perfectly understandable. We lost the Fed put and the dividend yield put from cross asset trading at the same time in pretty much January 2021 to 2022, and that was a bear market. That was bear market fuel. There's no way that we could have not gone through some kind of serious corrective process. And then sentiment got ridiculous, truly ridiculous. And now we're unwinding that. And I think that we probably most of the way unwound that. And probably there's a little bit of FOMO which could still happen. And then the retail side can get crazy in the other direction, especially if we've got remember the last sentiment flow show, I said, I think the last two I've said, maybe even the last three, now that I think about it, I've said the analog for me is 1994 in this market. That doesn't necessarily mean that all of the late 1990s have to come next, but there's a very similar kind of there's a rhyming situation here because people were just extremely bearish in 1994. The Fed was really working hard to try and promote the idea that it could engineer a soft landing, and it actually ended up working out. But that's because, of course, the internet was coming into its own, and there's this huge growth engine happening, and you had this excitement that then followed, and now we've got kind of a corollary with a lot of new emerging technologies. Obviously, AI being the most prominent, but there's a number of kind of paradigm shifting themes entering the picture now. But we've got people really, really bearish. We've got the Fed trying to engineer a soft landing, and we've got this turning round the corner to a new, bright future dominated by ridiculously powerful technology. Those things are all kind of in the mix at the same time. And the last time that really was the case, I think, was 1994.
Okay. All right. Let's circle back, Brett, real quick and talk a little bit about the Fed here, as Powell obviously has been up on Capitol Hill the last two sessions. Got the hawkish pause is widely expected. The terminal rate moved to 5.6% from 5.1%. Powell himself came out saying that 2 more rate hikes is probably a pretty good guess, which, obviously lines up right with that terminal rate move. Dot plots also looked up to that. PCE prices, that was edged higher, showing that inflation remains entrenched. Unemployment rate dropped lower. GDP moved higher. So, soft landing definitely seems to be the base theory for the Fed. July is a live meeting, so they're very data dependent on everything going forward. Noted that inflation risk remains to the upside and wants to move at a moderate pace. So collectively, with what Powell's been saying the past couple of days in the Fed decision, do you really see that playing a big impact on the markets moving forward? Obviously, the economy, it could definitely have a major impact if we start seeing a major slowdown because of these higher rates. But do you see hawkish rhetoric really having as much of an impact moving forward on equities on a day-to-day basis?
I guess it's going to sound a little strange, but I guess what I think one of the most central dramas is do people start to settle on the idea that UK inflation is idiosyncratic to Brexit and what the Bank of England is facing? Or is that canary in the coal mine for the next stage for central bankers of major world economies? You know what I'm saying? So I feel like it's possible that they're a bit of a special situation. And that's been kind of is the Fed really going to have to shift it to another gear? And we go right back to where we were first half of last year in terms of understanding the Fed's relationship with the markets, or do we start to isolate, the UK as a special phenomenon, and we look at the fact that we've seen declining CPI like 13 straight months now on a year-over-year basis?
13 straight months.
And start to say that that's our reality.
Yeah. And the UK, they definitely have that added uncertainty around what exactly did Brexit do to their economy, right? So I think that there is enough there to kind of explain away the BOE as a one-off and the UK as a one-off in terms of why they continue to see these elevated inflation points.
And I can tell you, I was just in London and Oxford, and these people are unhappy.
Yeah.
It's an unhappy place.
Are they talking about reversing Brexit at all?
Everybody hates it, but I don't know if they think of it as reversible.
Yeah.
And I think that the problem with that is the game theory for the EU is they couldn't let that happen because then everybody could try it out, right? And
Right.
If UK can reverse it, then Spain can say, let's try a Spexit for a little while and see how that goes. And if not, we'll come back. And
Yeah.
that'd be turmoil, right? If they all try it.
Right.
So
Because then it's just constantly in flux with
yeah,
all
it's
the
sort of
different
like you
members.
got to set an example. I think they
Or
can't
or
wait.
or you could just make it very punitive to come back in, right?
But then they're not going
Which
to. So
which means that they won't do it. But
yeah, it was a stupid thing. They shouldn't have done it, and now they're paying the price. And now the EU has a perfect way to go. See, we told you, and they can use that line to keep everything else together.
right.
Point to the UK. You don't want to be like them, do you? So it's really. I mean, it's very effective for the EU.
Yeah. So, well, I know what the Fed did with the holding further rate hikes coming. 51% of respondents in this J.P. Morgan Fed survey were expecting that. So I don't think anything was all that surprising on that nature. Perhaps the two rate hike talk is surprising people to a certain degree, but at the end of the day, Brett, I think that it really doesn't disrupt the idea that we're still closer to the end of quantitative tightening rather than the beginning
Yeah,
rather than a lot further road to go. So
and I wonder if they could continue the pause. Just kind of like because it takes a while to feed through the hikes that they've already done, and if there's no panic, they can get another month of data, and we could see that narrative. Like just like we approached the June meeting, we got right in front of the blackout period, and then we sent the missionaries out to say we're not going to do it. Remember that? I mean, like it was
yeah,
going to happen until we got right in front of the end of the blackout period, and then we had the series of 3 or 4 Fed speakers come out and say, I favor, a wait and see on this one, and we'll probably hike next one. And I could kind of imagine them doing that every meeting for a bit.
yeah. Well, obviously, as they said, data dependent. We haven't really had any major data points since
And it takes a
they've
while to
talked.
feed through. If it's not an
Um,
emergency, let's get another month. Let's let the previous hikes do their work.
yeah, and
So like
you
if
got,
you give somebody medicine and it takes 20 minutes for it to take effect, after 10 minutes, if you give them more medicine, is that the right decision? Like you want to wait and let's see if the medicine is working.
right,
And
and on top of that too, they got other levers to press, and to wit on that, you take a look at what they have to say about these bank capital, the stance on banking capital, which certainly hawkish from what we've seen between Marty Grunberg, the FDIC chair earlier today, and Fed Chair Powell too. So that's going to be another form of tightening going on. And for those who aren't aware, they were basically looking at banks in that 100 to 250 billion in asset size category that they were going to look to expand the amount of capital that they have to have for both the TLAC capital, looking to raise that another 20%. And, that's going to be a tightening in its own right. So, Bloomberg was talking about using the Basel III endgame draft rules that, are going to go into play for the SIFI banks. But now we're talking about expanding it to all those super regionals that fall into that 100 to 250 billion area. And then again, at the testimony in front of Congress, Powell was talking about raising capital levels by about 20%. And that's really going to cut off what banks could do on lending. And we talked about that back in the March sentiment and flow show when we were talking about the knock-on effect from what was going on there. So that does give the Fed another lever to pull that allows them to pause a little bit too, right, Brett? Where they can kind of still work on choking off inflation, but don't have to do it through the normal channels, or
sure,
at
they
least, or at
kill two
least the
birds with one
most.
stone a little bit.
What's that?
They can kill two birds with one stone a little bit.
Yeah, shore up the financial area and also
Yeah,
cool
right.
off
Get the
inflation.
banks in line in the same breath as cooling off inflation.
Yeah. So, with that in the back of the mind, and the official Fed capital rules are going to be coming out on Wednesday, I believe. So right in front of the bank stress test. So that'll be something that'll definitely be worth keeping an eye out on, just in case there's anything that's going to freak out the markets. Obviously, people are going to be looking at anybody with large commercial real estate exposure there and see what kind of impact they're having.
And so the next blackout period is going to,
for the Fed,
so it's going to be
that's
probably
July
around
12th.
July 12th. Yeah, right. So
July 26th is the next meeting.
Right, so July 12th, yeah, exactly. So we're going to be looking for Fed speak on the 10th and the 11th, coming out and saying, you know what, maybe we'll pause again this month, but definitely hike next month.
See, I don't.
Do they just do that every month for a while? Do they just come out? We're definitely hiking next month, but this month we're going to pause it. Could they just keep doing it?
I don't think that they'd want to pigeonhole themselves, although they have done that in the past, right?
I mean,
I'm of the opinion that the market doesn't care about that, Brett. I'm more of the opinion
About
that come July 12th, I don't think that the market cares. It's already priced in, right? We got about 75% chance according to CME Fed Funds futures. I don't think the market fears another 25 basis points. I think.
I agree with you. Don't forget, what would price in if they did that?
Well, don't forget, between July 12th and July 26th, we're going to have all those bank earnings coming out, a couple of big tech earnings. I don't know if Apple comes out before that, but Q2 earnings for me is the big key event. And one of the things that I've been noticing the last couple of weeks here, Brett, or at least over the last week, people aren't getting rewarded for big quarters anymore. KB Homes being a perfect example of this. And, it just changes the bar. You talk about the change in sentiment in terms of, what we're looking at for Bulls versus Bears, right? Talk about change of sentiment around earnings. And the last slide that this presentation will go through, but really what people are looking at more is, better than feared's off the table at this juncture, Brett. Now it's put up or shut up for earnings. So that changes that dynamic a lot. And I really think that the Fed, surprisingly enough, is kind of going to get overshadowed by this earnings season, is how I see it playing out.
I think that's certainly true.
So let's take a look at some of the other slides here we got on the Fed, talking about Fed expectations moving forward here. Do you think the Fed has finished its rate cycle? As you can see, this is from the June versus May. There was a big uptick in no versus yes. So, that kind of plays into
they said it,
our conversation right there.
I think this could just keep. I'm just really curious about the possibility of them this is the new strategy. Yeah, we'll see.
Yeah. Well, one of the other things too that we got to look at this drop off in core services ex housing, which has been that
Powell today.
Data.
Did you hear him?
I didn't hear exactly his exact words on this.
We made no progress on this.
I did see that. Okay, yeah, but I mean, it certainly doesn't show up in the Fed data, right?
Yeah, it's just rhetoric, I guess.
Yeah, I guess he's going off of his.
We feel your pain.
Yeah. We're with you against the man and all that.
We're on it. Yeah, right.
But the data, though, that doesn't really show that as much. So, I found that to be kind of interesting. So we'll be watching that.
Shows up in the stock market, though.
It does. It does. And I guess maybe that's something that people are looking at, that they're just not believing the Fed's going to need to be as aggressive as they are.
Yeah.
And,
so maybe July 11th. I'm telling you.
And even inflation psychology here, that's starting to normalize too. This is a nice little slide from Goldman.
All right, I'm calling it right now. July 11th. Who's it going to be? It's going to be Williams. Maybe I'm favor kind of a pause again this month.
Well, I mean, Bostic already started that parade, right?
Well, it's got to be right at the end. They've got to wait until the last couple of days before blackout and do the same.
Sure.
And then, but next month, we're definitely going to do it. It's got to be next month. We are definitely going to do it.
And then get the Wall Street Journal articles out.
And then what's his face? Yeah. All right.
So the inflation's starting to cool off. Here's the total assets. You can see had that one little brief pop because the Fed had to come in. and bankroll a couple of the overnight windows for some of these regional banks, but that is once again declining. This is, of course, the Fed balance sheet runoff. I haven't seen a final number that they would like to point to. My assumption is going to be somewhere in that 4 to 6 trillion range. You can see we're back down to about 8.4 trillion. But again, talk about getting towards the end possibly of the rate hike cycle, also getting towards the end of some of the balance sheet runoff as well here. Fed bank lending, you can see you're starting to see that emergency facility that they put into place getting used more rather than the primary credit levels. And so that it goes to show what Brett was talking about when this first came out. The Fed would be able to, I don't want to say print this away, but certainly cover everything. And I think that's evident here as you see an uptick in this program, Brett.
And
right?
remember the idea that like the TED spread sort of like a view of the we talked about the banking system as a hammock, like a rope hammock.
Yeah.
You remember? And if you cut all the strings in a rope hammock, nobody can sit in it.
Right.
And as long as the network stays together, then nothing matters at that point, as far as systemically. And this is just a picture of that hammock staying together.
Yeah. And that's exactly what you got laying out. Now, you obviously would prefer seeing this normalize in total for both facilities here. I mean, certainly as normalized for the primary loan facility, but the reserve one for now is still being used as people kind of get back in the footing. And this is likely to continue.
But the point is they're getting the liquidity they need without there being a breakdown without there being the dark forest game theory.
Correct.
Emerging, where I suspect you suspect me. I'm not going to do business with you. All of that breaking down. Like if the Fed can give people money without there being this perceived, deep dark counterparty risk situation, then it doesn't matter.
Yeah,
it's just numbers moving around.
Yeah,
there's no actual bank. 2008 was a banking crisis.
It's all
broke completely.
It's all digital currency.
Then that broke completely, and nobody had faith in anybody else. And then consumers saw that, and then they lost faith in the banks, and the whole thing fell apart. And this is completely not the same situation.
Yeah, which is always the case on a fractional banking system. Sure. So, all right. Taking a look, soft landing, that seems to be the base case. I haven't seen any data that would suggest otherwise. Do you take any umbrage with that, Brett?
What?
With the soft landing being the base case and the data that we've seen, have you seen any data that suggests to you that is not the case? Would be my question to you.
As of this point, I have not. I would be in the same camp as what this shows.
Okay, yeah. So Citigroup Economic Surprise Index, that's been running relatively in line. Certainly been getting to the both beats and misses. It's been a mixed bag, I guess, but you can see it's running in line with pretty close to expectations. So pretty good job at kind of.
I'm on a meeting.
Pretty.
Not yet. You got to go to Bommy. I'm on a meeting.
You're not on mute, Brett.
What's that? I'm not.
No.
God. We just had one of my 6-year-old daughters run in dressed as Anna from Frozen, asking me for balloons. So there you go. Okay.
Well, that's important. It's important.
It's my office life.
Well, so the Economic Surprise Index, this has been running generally in line. You can see running closely with the 10-year yield changes as well. So this hasn't been anything that's upset the apple cart here. You can see at times you got extremes. You can see how difficult it was for anybody to really kind of get anything correct around the COVID numbers there. But that has started to normalize, and we're getting into a really tight range, which is good. Which to me it means that economists and market forecasters have their thumb on the economy and a pretty good feeling of where we're going.
That's an interesting point in and of itself, by the way.
What's that? The improvement of data?
I mean, no. I always looked at this in terms of trying to find when there's one or the other directional issue. Like people are underestimating the downside potential for the economy, or people are underestimating the upside potential for the economy. One or the other, But really, there's another data point here, which is just that there are times when it's easier to forecast reality, whether it's bad or good. Just easier, like you can trust your analysis more. You know what I mean?
Yeah.
More predictable reality, which
Clarity.
probably more predictable
It's all
reality.
clarity, right?
Yeah, but think about how positive that is for, business investment. Like just knowing, just having more faith in the ability to forecast things. And when you're not in a weird once in a century crisis, when you renormalize back to a situation where you have a sense of we can trust the analysis that we get as far as what sort of world we're going to be living in 3, 6, 9 months into the future, then that's probably going to give people more confidence in terms of private sector business investments.
Yeah. Here's been one of the more interesting slides too, Brett. Hard versus soft data, and this kind of goes to your point in terms of how bearish sentiment's been compared to the actual hard data. And this is one of the things that I think people are having a tough time when, everybody talks about the ISM or PMIs being leading indicators, but for the last year now, that just hasn't really been the case, and we've continually seen sentiment, and we talked about it a lot the last couple of sentiment and flow shows, where it's just been so historically bearish that one has to wonder if people are just kind of building on their own misery and spending too much time on social media, because that data just continues to outpace on the hard side actual data to the soft data, right?
It's why I like to think about it's why I like to talk about the turtles is it's not just traders, it's everybody, it's households, it's analysts, it's everybody. Like when you see these sorts of cycles in terms of how people feel about the future, there's no way it's just traders. You could see the AAII data, 80 out of 83 weeks with people much more bearish than usual. There's no way that's just them just thinking about the stock market. Like it's pervasive. People saving more. Household savings went up. People unwilling to quit their jobs because they're afraid they can't get a new job, et cetera, et cetera, et cetera. Like it goes across everything. And certainly it goes up right into it. Businesses saying, what sort of demand am I going to see 3 months from now? And then you compare it with what sort of demand actually appears. Of course they're underestimating because it's the same thing.
Yeah, and I mean, it's just an amazing phenomenon that continues to play out. All right. So Bank of America Fund Manager Survey, cash levels, they were at the lowest level since January 2022. So that kind of points to what Brett was talking about starting to see that rotation going on. But commodity exposure remains at a 3-year low. So I'm going to ask you directly about that, Brett, because we just talked about sentiment data versus hard data, and one has to wonder when that could start impacting these commodities, which are seeing a lot of underexposure. Long big tech, no surprise there, the most crowded trade. Sentiment remains low, of course, and 37% think large caps will outperform small caps compared to a prior 47%. So suggesting in that survey that maybe there's some rotation coming. So, Brett, of these points that I've got here on the bullets, what stands out the most to you?
Well, one is, and I always make this point, the most crowded trade is a different data point than all the other data points in the fund manager survey, because they're not saying what they own the most of. They're saying what they think is the most crowded trade, which means probably, it's people who aren't like. I always kind of get this. Would you be involved in the most crowded trade?
No, because that probably means I'm going to get caught holding the bag, right?
Right. So if you answer long big tech is the most crowded trade, Are you in it? Probably not. And if that's the most common answer among large fund managers, then it's not the most crowded trade by definition. They're all looking at the stocks taking off and they don't own enough of them. So, like, I think there's always kind of this contrarian feel that I have about that answer. Because they're not saying, like, if they did the fund manager survey different, let's say Hartnett said, instead of asking what's the most crowded trade, maybe he asked that too, but he also asked another question is, what are you most overweight? And if everybody says big tech, then that's the most crowded trade, right?
Right.
Right. But what do you think the most crowded trade is? The answer to that probably isn't the answer to what the most crowded trade is. It's the answer to what people are probably missing out on. But and then commodity exposure at a 3-year low, and if we continue to see the economic surprises skew the same way, that's obvious in terms of what's going to happen. People aren't exposed enough to commodities. They're still waiting for the hard landing. And,
so if you were looking, would commodities be at the top of your?
Yeah, it already is. I mean, I think like if you think everybody's waiting to buy after the hard landing, but then we already saw that now we flipped to where economic expectations are much better in this survey. So that models the picture a little bit, but I still get the sense that the way that crude is acting in particular kind of gives me that sense that there's just a kind of, we're waiting for some kind of more, the blossoming of some kind of economic downside. Maybe it's not a hard landing. Maybe it's just sort of a 0% GDP quarter or two globally.
I mean, I feel like it rotates a lot around what China's going to do, right? And there's a lot of concern
and there's
about
China's,
the
right.
weakness
China's,
there.
right.
People would like to see a little bit more on the sentiment side coming from China, or on the stimulus side, I should say. Yeah.
So and then the large caps. Well, so hold on.
37% think large caps will outperform small caps.
So that's going down.
That's going down. The prior was 47%. So therefore, do we start seeing the rotation into the Russell, into the IWM names there?
Yeah, that's the idea. I mean, I guess it would take broad-based kind of repair in terms of cyclical dynamics.
Well, it'd be all part. Yeah, exactly. The cyclical improvements, or at least the removal of some of the concerns. I think people continue to think that there's going to be some sort of big recession coming from the Fed, and once we can kind of maybe work our way through that, then that we start seeing that rotation. But knocking sentiment off that recession. I mean, I've been hearing for 18 months now about this recession, Brett, right? So, I mean, it's the most long forecast of a recession I've seen since I've been in the markets, I would say.
Yeah.
So, and at some point they'll be right?
Yeah.
In 2 years from now, I'm sure we'll get some "I told you so"s from some of the bears on that.
Right.
All right. Looking, sentiment remained low overall in this survey, I would say. Percentile rank, of FMS growth expectations plus cash levels plus equity allocation here. You can see this just remains stubbornly low. It is starting to try to peak up, but we haven't got anywhere near that COVID reopening. And that's why I think that we still got money coming off the sidelines that could really impact this. Certainly some of it has come off, but that's why I've been loath to try to short too much over the last couple of days, just because I really feel like at least into quarter end that you could get that big squeeze and FOMO chase.
And it's interesting that this goes across multiple categories, right? In terms of I mean, it's broad economic growth plus cash level plus equity allocation. So that's an interesting data point.
Yeah. Here we go. And this again points to the FOMO. Talking about no let's go risk on. You can see how low the month over month change in positioning has happened here for cash. Big drop off there. But just kind of looking at this, the equities and commodities positioning is a little confusing to me. A lot of money moving into alternative investments there, Brett, which I you didn't have a definition for what they're looking at alternative investments. But this slide kind of caught me off guard a little bit. And some of the reason why I think that there's some more moves that could happen in terms of positioning and money still to come in off the sidelines.
Yeah, right. Sure.
There's cash level dips that we were talking about, dropping at 5.1%. This is,
But just 5.1.
yeah, it's still elevated. I think what
At the top end of
4.4
the
is like
historical
the
range, yeah.
historical average, right? So, you know, it's still room for money to come off the side. And here is the slide that I came across too with the CTA positions in the U.S. equities. This shows some of that money coming off the sidelines that you were talking about before, Brett, right? The historical average running right around that 30, or they added 39 billion. That's an increase of 20 billion since April 1st. It's in the 99th percentile over the past year in terms of month-over-month improvements. So certainly the CTA position was piling into the U.S. equities there. You got any thoughts on that, Brett?
Hey, sorry.
Okay.
No,
No
it has
problem.
happened once at least.
No problem. Let it go, Brett. Let it go.
I can't. God, stupid. Ugh. No, yeah. So it's very clear, exactly what you said.
All right. So then retail returns. So this is one of the more interesting aspects too, where like if you got institutional money, this goes to the portfolio manager sideline thing that I was talking about earlier, where retail was definitely quick to jump in on this. You can see how they were just diving out going into that debt ceiling debate, and you can see how quick retail can be pretty finicky. Look, that one dive down here, that's right around the banking crisis, and then another dive right around. So retail definitely would be the fast money in this perspective, right?
But
Brett?
no, this is the percent of volume,
Percent of SPX volume, yes, that is being
not
traded.
gains or anything. Like, I'm just saying, like
Not gains or anything.
They could be
but just
losing every one of these
participation.
trades. Right?
It could be.
They
Yeah.
stop participating completely when they know they don't know what's happening, and probably when they suspect that there are other people who do know what's happening because of their place in the pecking order in the information world, and that therefore it's just silly to be at that table in the casino.
Right.
I mean, like if there's, especially with the debt ceiling stuff, like you just know when you're not at a big fund, like you just know somebody's got connections with somebody and they're in the room when the negotiations are going on. I don't have the phone call to somebody who just got out of the Oval Office and is giving me advance notice of what's coming. So like there's lots of times when retail's just going to stop, right? It's going to shut off participation. But yeah, I mean they're as
This
soon
has
as
not been one of them though.
Well, no, I mean for a second it was.
Right,
And
for
then,
a second one, yeah.
Yeah, sure.
So and they're also of the mindset of always trying to catch tops and bottoms, I suppose, too, right? So you got that aspect that plays
Well,
in.
but when there's momentum, when it's game on, though, I mean, it feels like game on again.
Yeah.
Right? I mean, all your favorite, hey, it's time to buy Tesla.
All right. JP Morgan had this slide in one of their recent notes here. And they were, so this is S&P 500 speculative net long futures. And you can see that there's a decline in this. Now they're talking about bearish positioning and that they don't think that this is indicative of bearish positioning, but
why exactly?
That's what I'd be curious about. That's why I kind of wanted to throw this slide on just to get your
don't
thoughts.
Think so.
But I mean, to me, it looks like it is. Am I missing something?
Pretty clear that.
Right.
I mean, well, and I
also
know that at the same time.
I mean, it
was the
shows
highest net short speculative positioning in futures since 2007. I know that at the same time.
Right.
That's also the case.
And I guess that would kind of be one of the key points of this, right?
So somehow there's something else in their note that explains why this is part of a complex hedging strategy for some net long strategy or something.
That would be my assumption.
It's ridiculous.
Yeah.
which is absurd. Is this Marko Kolanovic again?
It
Just
is a
like,
Kalanovich note. So
is there
there you
ever
go,
been
right?
a guy who's more wrong? How has he got a job? Like, do you remember last year? Like
He was bullish
every
all through 2022.
oh my god! And then starting October, he's super bearish.
Yeah.
And this is the top chief strategist at the #1 investment bank in the world.
Yeah.
How is that?
He's had that 3,000
It's
price.
crazy.
And they keep doubling down, both him and Wilson.
Yeah. But at least Wilson was totally right on the first leg.
Yeah.
Like, you can't, man, how could you be that wrong on both sides of it? And, man, that guy's had a rough stretch.
Yeah. So moving on, JP Morgan Bull survey here. Is last week's market move make you more positive on equities? And you can see a lot of the JP Morgan clientele weren't of the opinion of getting sucked in, which is again why I think that there's still a lot of money that could just rally us into the quarter end here, especially given some of the charts that we've seen. So I was interested to see this now. Moving on, here's their investor survey too. Where are you more likely to increase or decrease equity exposure over the coming days, weeks? And you can see this has moved up to the 51 percentile here now, which is the highest in a while. But this is in the coming days and weeks. So the question is, how much of that 51% already went into the market would be what I'd be curious about.
Yeah, I mean it's a smaller degree version of the other data points we've seen on this sea change, etc.
And here's the JP Morgan positioning note here. You can see a lot of them running. We've seen a big move from the 30th, 40th, and 40th, 50th up. So there are more people climbing off the sidelines, as evident by the moves, but still plenty of people that remain on the sidelines here, Brett. So, and then next, earnings expectations. I thought this was an interesting slide. This kind of I wish I had gotten this out last week because it would have been kind of helped to explain why we're seeing some of the more recent reactions to guidance and earnings where people just aren't getting as excited. And you can see there's an uptick in expectations around this with more people moving into the growth of the up 0 to 5% or 5 to 10% range from some of the lower ends. And that was really across the board from June into May. So the corporate world's not going to have the better than feared pass that they've had the last couple of quarters. And
that's an interesting way to frame it. Yeah, right.
Yeah,
but it's still the same. It's still the same shift. I mean, this is the same data point as the AAII. I mean, really, it's just at a certain point, the sense that we're heading into some kind of abyss is receding, and so it's probably like a pullback from the brink of thinking that there's going to be some devastating recession right around the corner. And so,
right, yeah, exactly. That's the thing. However,
but the expectations shift. You're right, and therefore the reactions are going to be different.
Right, reactions are going to be different, and just the overall consensus outlooks, which means the bar is going to be a little bit higher, which leaves room for some underperformance potentially too. I think.
Yeah, but it depends on how much money's still on the sidelines, though, and that's what we got to figure out. And I'm not. Yeah. I'm still kind of in my. I'm not sure how much of the transition we've made. We talked about it.
Yeah, and then here's the crowded trade slide there, which Brett was talking about. That long Japan call, Brett. I wish I stayed with it.
Yeah,
that would have worked out nice. And it's
Buffett
funny to see that. Well, yeah, Buffett stayed with it. I should have been just with him and not tried to guess gains. I got shaken out by the in the March drop.
You didn't beat Warren Buffett.
I know.
God, dude.
I'm no oracle for sure. But big decline in the short U.S. banks, though. I would note that. So, but the data really has, the performance still hasn't really been there. And then there's this tech versus energy, which we were just talking about, which with that overcrowded trade, Brett, right? Where
so interesting.
You're just seeing once again, obviously, net percentage overweight tech, the highest since September 21. And it really might even be higher at this juncture now. So You're of the mindset to, as Wayne Gretzky would say, skate where the puck's going, not where it is, right?
Most quoted business book quote there is.
Really, over Mike Tyson, you think?
Yeah, everybody has plans to get punched in the face.
Yeah.
Yeah, I think so, from what I've heard, because my wife just quoted it in her book. And
The Gretzky quote?
Yeah, we researched
no.
that it was the most quoted business.
Was it?
Yeah.
Interesting.
Yeah, skate where the puck is going.
It's interesting to see two sports figures with the top business analogies, right?
They like to get that kind of
Well, just the fact that Mike Tyson is behind one of the greatest quotes of all time and
it's
meaningful
awesome, right?
quotes
It's a great
is
quote,
fantastic.
though. Get punched in the face. It's awesome.
It is a great quote. Never truer
Especially
words
since he meant it literally.
In
You know what I mean?
In 2,000 years from now, Mike Tyson might be viewed as Socrates by some.
I think he's got the face tattoo for it. So
He does.
So yeah, I mean, I as far as tech versus energy, like, I mean, you can look at this as two ways. I mean, obviously on a super long time frame, it makes perfect sense to choose tech over energy, because energy is fossil fuels. We know where that's headed. Tech is artificial intelligence. We know where that's headed. One of these things is going to pay for everything if you buy lots of shares. You may not have a job. Your income may just be, your shares in tech over the next 50 years. And that's certainly not going to be the case for energy. So structural, secular time frame investments, pretty easy to see why you favor one of those sectors over the other. But you get to a certain point, and there's going to be, I've painted this picture of the transition that we're looking for in energy. We have underprepared for a bridge transition period, where we could see skyrocketing energy prices and fossil fuels, because we still need them more than we thought we did, and we haven't invested in infrastructure, and we're going to need to suddenly pour a bunch of money into these companies. So maybe that doesn't pay off for a long-term investment, though, in the actual equity. It's a really interesting question, because what if what if that a company is going to experience a massive boom in earnings over the course of a 5-year period and then have no viable future?
Yeah.
What kind of multiple are you going to get on those earnings, right? So, it's a really interesting. I don't know if we've ever really seen a situation like that, where a whole sector is basically going to, over the course of a 20 to 25 year period, is just going to disappear. And
or do you think the death of energy has just been greatly exaggerated?
I think we're going to transition to a different type of energy economy. I just don't know, what form it's going to take. I mean, probably it's going to be more gradual than people think, but I definitely think that I'm a firm believer in the science behind the idea, regardless of what anybody thinks of me for that. I got enough information to make that decision. So I think that we can over the long term do this without, burning stuff that creates greenhouse gases. Pretty simple to look at the science. But I don't know that, I think that we've misjudged the time frame. And I think also there are solutions other than just stopping doing that. I think there's technology that could possibly remove carbon dioxide from the future that could be really important. That's already in, advanced research stages in serious, research institutions. Like, that's another possible thing that can happen. And that could kind of mediate this outcome. But I think probably, we're headed, we've proven on a very base level, we have proven fusion technology is a workable thing. You can get more energy out than you put in. And certainly over the next century, that's going to be what happens is nuclear fusion technology. Like, that's going to be our energy future. There's no doubt about that. Yeah. So like, that's where we're headed. It's just like, is that 50 years away, 40 years away, 30 years away, 20 years away, 10 years away? Who's it? Did Microsoft just make the bet on 5 years?
For what?
For fusion.
I didn't. I think
Microsoft did. Bill Gates made a big kind of publicity thing about it, and one of the top fusion research companies basically saying, we're going to, invest massive amounts in you if you can make this viable in 5 years. So there's pressure to try to make that happen right away. That I think is the long-term answer. But fossil fuels is I think there's a good chance that there's this bridge period that we're not able to sufficiently supply enough energy for the world in 2027, 2028, 2029, 2030, because we haven't invested anything in expanding fossil fuel production capacity in 2010, 2011, 2012, 2013. It takes a while to develop these things. And we've never gone through a 15-year period since we started with fossil fuels, more than a century ago. We've never gone through a 15-year period where we've had such a small amount of investment in new capacity, because everybody can see this transition coming. And if we misjudge that and we end up with, rationing power around the entire world for 3 years, think about how much a barrel of oil is going to cost. It's going to be really, really expensive just on basic supply and demand characteristics. And companies that own that oil, you'd think would be worth a lot of money in an environment like that. But, and this is a question I wrestle with, and feel free in the comments if you've got a view on it, but, what do you get as a multiple on earnings for that if you still know the end is near for that whole industry?
Yeah.
And it's I don't know if we've ever really seen kind of a.
Well, I mean, the way they trade, you would think not very high, right?
You'd think that's what the market's trying to say, right?
Outside of utilities, energy is the cheapest.
But of course, part of that is some people think that the bridge is not too far.
Yeah.
Like it's just going to phase out now, and we're just going to gradually see a growing market share for alternatives, eventually shifting to fusion when it comes about. But that, we could do it with fission and solar and wind, etc. In 2029.
Right.
All right. So it's an interesting question.
It is. But obviously the positioning here backs you up with the idea that you're going to see tech well outperform energy moving down the road. Let's see. And then credit risks, just kind of pointing this out. High inflation keeping central banks hawkish was the number one. Certainly seen evidence of that. But again, as some of the slides that Brett and I showed, some of that inflation data might be coming up a little bit faster than some people are looking for. So bears watching on that front. Bank credit crunch and global recession was number 2 at 22%. So
but this is overall risks, right?
This is overall risks,
okay.
Correct. And then you got geopolitical events worsen, China, Taiwan, Russia, Ukraine, of course, systemic credit events, and the AI tech bubble. I don't see that being a major issue, though, because most of the names that are getting run, Brett, are legitimate names that, could. I don't see it's not like 2001 when you would you'd see companies get run up that had $200 in revenues,
That's.com, yeah.
Yeah, like Double Click and stuff like that were just going
zero revenues,
yeah. So at least most of the names.
So grouping those two together was kind of a mistake in this survey.
With the bank credit crunch and global recession.
Yeah, because people are just like, well, I don't believe in the bank credit crunch. I mean, it'll be contributing.
Yeah, they should each be their own point.
Yeah, right. I mean, you really don't get the information there.
Yeah. And that is the last slide we got there, Brett. So, all right. So I guess the primary question is, do we think that there's been an inflection point in the markets in terms of, no longer is that positioning firmly in favor of the bulls? And there's definitely
or is that enough to drive it by itself, let's say?
Right. And I think that there's been enough evidence out there to suggest that, obviously, just looking at the price action, there's certainly been money coming off the sidelines, certainly been some short interest that's been reduced. Sentiment data has definitely flipped from that extreme bearish side onto the bullish side. So there's elements that suggest that a lot of the move has already been priced in. And a lot of that, a lot of the things that we've been talking about for the first part of the year have reversed. Now, I still think that there's further to go.
Oh, sure.
I'm kind of the opinion that we'll see a nice push higher into the quarter end, and through the 4th of July weekend there, right, Brett? Maybe afterwards. But then we get into some interesting times where, for me, the biggest event to come for the next couple of months is going to be this Q2 earnings season, and how banks and how these companies are performing, and whether or not they're starting to see any sort of favor. So I'm certainly in the bullish camp until we get into Q2 earnings. But like you said, it's not as clear cut as it's been, I would say, over the last couple of weeks and months. So, from your perspective, Brett, where do you think we stand in this cycle right now?
So if a gun to my head, and I don't feel a tremendous amount of conviction about this, but if I had to take a slightly different framed position from what you just expressed, I guess I might say I think we might consolidate into those earnings and then break out further after them, on them. That people really haven't fully made the adjustments, and that they're going to start thinking that the bottom is going to end up dropping out of this, and that earnings are probably going to be sufficiently good to alleviate that, and people are going to go back into FOMO mode.
So I guess the biggest difference that me and you have in terms of direction is how quarterly window dressing plays in. Would you agree with that?
Yeah, I don't believe a lot in quarterly window dressing.
Okay. All right. I'm of the opinion that there's going to be a lot of people that don't want to have to answer on why they missed this rally myself.
It makes sense what you're saying. I get you. I feel like I have a hard time thinking that that's going to be that big a factor. But yeah, no, it's a very reasonable argument.
Yeah. So, but I would say that it sounds like both of us kind of remain in the camp of being bullish. We'll have
Simple
to see
market.
the. Well, yeah, exactly. We'll have to see the data, and certainly valuation is going to be something that's going to come into play at some point.
Is
Not,
it?
yeah, I guess not, right? I mean, it's got to. There's got to
Does
be
it
that.
ever really?
Yeah, I think when we get to that 20-point rule, right? I mean, where are we
I
at
don't
right now?
know.
We're at, we'll call it 4,500. Quick math here, 45.
It's so elastic.
It is.
So
It's very
contingent.
elastic. I mean, if we're looking just going off 2024 earnings here, we're looking at 4,500 divided by 240. It's only 18.7 times forward PE looking at 2024, which is reasonable. And I agree with, I think Jeremy Siegel's always out talking about the new normal for valuations. And I do think that there's an element that the
Is it
historical
new?
valuation should be higher.
Well,
Well,
okay. Well, that's interesting. I mean, I just think it. I don't know.
it's of the mindset that it used to be what 16 times was the historical average around there, right?
Yeah, that's just
But there's just more
an
liquidity. It's
artifact.
inflation. It's inflation like anything else, right?
Sure, but I don't think anybody makes a decision on a daily basis
True.
by looking at that. I mean,
True.
you know,
Maybe for some profit taking.
it's a good retrospective data point.
Yeah. But all right, Brett. Well, I think that will do it for us here on the Sentiment and Flow show. We got just about 10 minutes left in the trading day. We have been going higher through most of this discussion here, running up around 44.20 for resistance in the S&P. The Nasdaq, for its part, is running at 15,200. It's testing that. That's near session highs at this juncture now. So just I guess people have been liking what we have to say here, Brett, and buying going around it. But any trades that you're eyeing up in either one of these indices or the diamonds coming up?
I wanted to see just one more shakeout day and start buying, and I wanted to see the feeling that it was push rather than pull on the downside. People, I mean, what was easy for me, weeks ago, the push downside, where where you've got people who are bearish, deep pocketed, and are shorting hard. And there's not much other downside. And the pull downside would be when there's people who are over levered long and they get too far out of the money, and they've got to just bail. Like that's pull. Push is there aren't those people, and there are a lot of people who think the market should go lower, and they're hitting, they're hitting the bid with big shorts. We didn't see we didn't see a lot of either of them. We didn't get to anything that I saw on the tape where it really showed me either of those two states, and I really wish that we saw the push on the downside to undercut yesterday's lows, and then a kind of, something that looked like a constructive resolution to that. It really would have been an easy long, and we just jetted higher off the open, especially in tech, and it just made it difficult.
Yeah.
But I wish that I found some pattern to get me long today.
Yeah. I was eyeing up a short like you. I am just banking a piece of the snow long here that's made a nice bounce off of that 172 area that we were looking at. So moving the stops to 170. And this is, kind of one of those examples that I was talking about that 20-day moving average coming into play here for a lot of these names. So, snow definitely bounced off that nicely. And
Exponential or simple?
Exponential.
Right.
Or just simple. I'm sorry, simple.
Okay.
So, been watching that. If you take a look at, the Qs, it was starting to get a little bit closer to the 20 there, but the SPY as well, still a little bit above those averages. But a number of big names coming in for key tests of that. So, watching that play out right now. So Brett, always a pleasure chatting markets with you here. I am going to shut down audio real quick, and we will post the replay of this for anybody that might have missed some aspects of it. And then we will be, I'll be jumping back on audio here shortly to take a look at the after hours. No big earnings coming out of note here for it. So it should be relatively quiet.
Okay.
All right, Brett. We'll talk to you soon.
All right.
Take
Take
care.
care, guys. Yep.